Now starting. All attendees are in listen-only mode.
Good day, everybody, and welcome to our webinar today with the team from Merchant Tech. We'll be chatting to Workforce CEO Ronny Katz. My name is Dinelle, and before I hand over to Brian, I just want to make sure that everyone can hear me. So if you can hear me, could you please lift your digital hand? It'll be the hand icon next to your name. All right, I see a few hands. As always, Brian and Ronny are going to have their discussion. Please feel free to send your questions through, and they'll be addressing questions right at the end. And without further delay, I'm going to hand over to Brian. Brian, hello.
Hi, thanks very much for that introduction, Dinelle. So, good afternoon, everyone, and welcome to one of our regular Merchant Tech Research webinars in association with Standard Bank Online Broking. My name is Brian Ronny, and I'm a Director of Research for Merchant Tech. And please, just remember that all our research on some 40 small cap companies is available on the Standard Bank Online Broking Research website. So today we are talking to Workforce Holdings, who have recently announced their interim results. And I'm joined today by the CEO, Mr. Ronny Katz, and Financial Director, Mr. Willie van Wyk, to talk us through their latest results. So welcome, gentlemen.
Thank you.
As Dinelle said, it's really, I'm going to ask a number of questions of Mr. Katz and take him through a guided presentation around the results and also just to really get a sense of where the company's at in terms of the future, how it's coped with COVID, and what the prospects for recovery look like. If you have additional questions, please pop them on the platform and we will take those at the end of the session. So by way of very broad introduction before I hand over to Ronny, Workforce provides human capital solutions that include employment and contracting services, training, healthcare and wellness solutions, as well as a range of financial services, mainly into that base. It has an annual revenue of around about 3 billion, and normal operating profits would be around about 150 million. Currently, given the effects of COVID on the most recent results, we've seen that there's been a recent 30% decline in the share price. And the market capitalization of the business has come down accordingly to around about 200 million. So the share is currently trading at around about 80 cents, which is a full 75% discount to its net asset value and almost half of the tangible NAV. So we certainly believe that there is huge scope for upside once conditions normalize and the business can demonstrate to the market that it's recovered and has its earnings potential back on track. So before we get to the actual results themselves, Ronny, perhaps you could give us a quick refresher overview of what you consider to be the most important things about Workforce and what it does today. Touch on the divisions. Thanks.
Yeah, thank you, Brian. So, taking a broad look at what Workforce does today, we see that there's been quite a substantial change over the last 4 or 5 years in what it does. Workforce was primary, and its main business was always the outsourcing of staff in all industries, and it has a very large footprint throughout South Africa, about 80 branches, and we outsource approximately 35,000 staff on a daily basis. That was the picture as we turned the corner a couple of years ago when we decided that we would like to diversify out of pure staffing and focus on the various areas which we had internally developed to support the staffing side of the business. So we had a training division, we had a healthcare division, and financial services and recruitment, and we decided to convert those all into self-standing businesses where their audience, their customer base was no longer just Workforce Holdings, but at the public and companies at large. And the intention was, and still is, that Workforce Holdings becomes an investment company with investments in these different businesses, each of which has to be self-sustainable and of the size which would justify a separate listing. Not that we're looking at a separate listing, but that is the size that we're looking at. So over this period, we have built a fair business in the training segment, in the healthcare segment, and in the financial services segment. And what we have also done, which we call our fifth arrow to our bow, is we have diversified on a slow basis into Africa, because we believe that all of the products that we do have, we have the IP, we have the infrastructure, and we have the technology to develop it, certainly within the SADC countries, which would give us a market instead of 56 million people of 386 million people. So that's an ongoing work in progress, but that is an overview of what we look like today, Brian.
Yeah, thanks for that, Ronny. And perhaps we can dive into it now, and you can take us through what has happened in the last 6 months in each of those
Yes.
divisions, and take us through that. Yeah.
Yes. So when COVID hit us in March, we were faced with a dramatic loss in turnover. Only essential services were allowed, and although we do support a number of essential service businesses, the majority of our business is across the board and not essential. So there was a substantial drop in turnover, and that put us a bit on the back foot, although I feel that we did react very quickly and created the necessary task teams to handle the COVID, to handle our cash flow, to handle our overhead and cost controls, and our health and safety, with a very big focus on the health and safety of our staff. As I said, we employ about 35,000 people, and immediately that the state of disaster was declared, 20,000 people had to be laid off or put on short time. We did not retrench people. We rather put them on layoff, because we regarded this as a short-term measure. And by laying off, we were also able to claim approximately 132 million rands worth of TERS, which we distributed to the staff who were not working, and gave them an income. We also, at the same time, were able to, and did, organize food parcels coming for a value of about 13.5 million. And these were all steps that we took to support the staff that we have, and also to ensure the longevity of our business going forward. On a cash flow basis, we were able to improve our liquidity substantially, and we turned the year with cash generation of approximately 300 million, and cash in the bank, cash and cash equivalents of 156 million, which stands us in very good stead for the period going ahead. And we feel that we are pretty secure from a point of view and a cash point of view for the period coming ahead. In our different divisions, what I would say is, first of all, let's take a bit of a look at the overview in terms of period. In March, we came into March very optimistic, very excited, because we all believe in our model, and we thought that this year is going to be terrific. Came the state of disaster, we had our problems, and we still focused on our clusterization and our diversification, but albeit on a very much lower scale. April was really disastrous. I think on average, we reduced our turnovers to about 30% of where they were in March. And naturally, this had a big effect on our profitability. And we'll show you, or I'll go through it cluster by cluster just now. May was similar to April. And then finally, in June, we started to see the recovery. And we believe that in June, we went to about a 60% utilization. And July, we went to between 70 and 80%. And in August, where we are now, we believe we're running at about 85% utilization of our staff. We had in the interim during this period, recognizing that our overheads were aimed at a much bigger business, we went into a program of reducing overheads and consolidating our businesses, and we did that pretty well, we hope. And we were not aggressive, but we were clinical in what we did. If I can go to the individual clusters, because that will make more sense. Our staffing and outsourcing cluster, we provide staffing, as I said, 35,000 people. We've got a number of different brands, Workforce, PPO, Quinn, Oxion, and a number of other brands in the recruitment, Fempower, Acatech, Only the Best, and Teleresources, to mention a few. In the staffing and outsourcing, we found that permanent recruitment came to a total standstill. People weren't at all interested in taking on new staff. In fact, they all had problems with the staff that they had, and that we'll go into also just now. We had to pivot our business, particularly the business relating to temporary staffing, into other models. For example, going into process outsourcing as opposed to staff outsourcing, where we undertook to do the total function of the business rather than just the staffing, and we charged by a result rather than by hour. And that's a model which will see us well to going forward. The staffing cluster dropped from 1.2 billion in 2019 in the first 6 months to 978 million, and the contribution from 64 million down to 58 million during that period. We believe the outlook for this business, I think we're very nicely positioned, and there are a number of reasons for that. First of all, the period that we've been through has resulted in a number of our opposition becoming weaker in the market or withdrawing from the market. So we hope to fill that gap. The second thing is that we didn't lose one client during this period. It was the clients themselves all reduced their need for staffing, but we retained our relationship and continued building on that relationship. So as they're opening up and as things are developing, we are picking up that business on a daily basis. The other reason is that the government has committed to an infrastructure project of very large proportions, and the staffing that we employ are very well suited for infrastructure development. We don't know how long it will take for the government to get these projects off the ground, but we do believe that once they are off the ground, that we will be able to participate in them. During the period, we also were very fortunate in taking over the full management staff and branch infrastructure of a company called Transman, which did not make it through the COVID period. But we were able to get the experience, the knowledge, and the customer base that they had without a lot of the overhead that they had attached to it. So we believe that will see us well in the future. The recruitment side, we appointed a new head to our recruitment cluster, a woman by the name of Evelyn van Nash. And Evelyn has just done a wonderful job in reducing the overheads. And she took really a substantial amount out and consolidated all of our recruitment businesses into one business. And this has given us a way forward and was the way to handle things during this protracted period of COVID. And the other thing that this particular cluster did was moved away from the permanent market into the temporary market and made quite significant inroads there, and that's going to see them well through to the future. The story that I can give you is that in the case of permanent recruitment, a lot of the employers are reluctant to take on new permanent staff because we don't know where we're going with the COVID, and maybe they'll have to reduce the staff in 2 months' time or come back. So we're seeing more of an interest in white-collar temporary staff, which we hope to be able to build on. The next cluster that I want to deal with, which was one of our clusters where we've invested a substantial amount of money in order to grow it, and we believe it's a very good place to be, and that is our training cluster. Our training cluster consists of a number of different brands. We have Dyna Training, we have Training Force, All-Med Training, which is a medical training segment. Dyna Training, the first one I mentioned, is a management training. Chartwell College, which we took over at the beginning of the year, is a company that is in digital training. It's a business college and does mainly, it does its main business with the banks, financial institutions and insurance institutions. So we are hoping to see that grow. The other part of our training cluster, somebody's gone over, anyway, is Prisma Training and KBC Training. They are both very involved in the mining industry, and of course mining came to a halt at that time, and so these two clusters, these two businesses really didn't do well. In fact, we ran at big losses in that period, and for us, the problem was that to retain the good training staff, we had to continue the business. What we're finding today is that the activities have increased. They're still not at the level where they used to be, but it has increased, and we're seeing an ongoing increase going in there. And the specialization of training within the mining industry is very important to us, both for South Africa, Southern Africa, and maybe in other countries as well. We've got very good technologies. Then the digital element in the business that we took over from Chartwell has also been quite a win for us, because the likes of Training Force and All-Med Training came virtually to an end because you couldn't have face-to-face training in the training center. or in a training room, and you couldn't. Your learnership training also required close connection with people. So that came to a virtual end. And fortunately, we were able to take the platform, which had been developed over many years in Chartwell Business College for digital training, and we've taken it and we've used it to develop the other training courses that we've had to convert them into digital training. And we're not fully there yet, but we're pretty well down the line, and we expect that before the end of this year we'll have done most of the conversion, and we're quite excited about what can happen in that business. The training cluster, in terms of figures, was 128 million in 2019, and it dropped to 108 million. The first half of last year, they made a 27 million profit, and that dropped to 10 million. So you can see the effect of not being able to train. And that was a great disappointment. But I must say that once again, our team is very positive, and they handled the situation very well. And I think they retained all the relationships that they had before. The next cluster was, or is, the healthcare cluster. And the healthcare cluster consists of workforce healthcare, which in itself consists of wellness centers, it does wellness days. It also has clinics, about 70 fixed clinics on client sites, as well as clinics which are mobile, and they use for screening and on sites, etc. And then the other part is DNA Wellness, which is really similar to Workforce. All Med is all medical services. So whether it's a doctor, a nurse, a dentist, we provide those as temporary and staffing. And then we have nursing emergencies, which also handles the nursing side. So in the COVID period, these two businesses did well, and were able to form new relationships. We're able to bring new products to the market, ensuring the safety of people when entering into their businesses or their sites. And there was a lot of development there. And in the last couple of weeks, the All Med business was fortunate to extend their contracts with the Cape hospitals for another 3 years, which gives us some kind of security. The healthcare cluster, in terms of figures, 132 million in 2019, which increased to 138 million in 2020, and the bottom line increased from 15 million to 22 million for the 6 months, and we expect an improved performance going forward into the next 6 months. The healthcare cluster is an area of focus for us to develop and bring it to the level that I explained earlier, an entity that could be listed on its own. Okay, so that is that. Then we have the financial services cluster, and the financial services cluster had a difficult number of months. It's divided up into two broad areas. One is providing microloans to our substantial staff base, and this is all on collection from the payrolls which we produce. And the second part of it is medical insurance and other insurance products, which we have devised ourselves. We do it in conjunction with Guardian, and they're fully underwritten, and provide a medical insurance which is really very good. It's low cost and has very good benefits, and we have found that we can sell it, and we have been selling it to very large businesses, and these are not necessarily connected to the group in any way, and we see quite a bit of expansion coming into this area. The first area that I spoke of was the granting of loans to employees. And what we did immediately was we stopped granting loans because the employees didn't have the employment. And in accordance with the rules that we have, we were not able to provide loans. And we retained this situation until earlier this month, where we once again have started slowly in providing loans to people that have employment with us. We also expanded these services into our Africa division, which I'm going to come to next. But before I do so, you'll see that in this area, because of the uncertainty of the continued work of employees that we had lent money to, we had to make a substantial provision or impairment provision against their book of about 46.5 million. And this naturally affected the results of this division quite substantially. We believe this will be a one-time impairment, and that the trading going forward will be done on a very cautious basis, whereby we won't have to continue to impair. So whereas in 2019, the company the financial services company made a small profit, in 2020 they ran into losses. So the next cluster that I want to talk about, which is very important to us and represents a big part of our growth strategy, is our growth into Africa. When I say our growth into Africa, it is, as I explained earlier, our product that we have in all of our clusters is very much a product that can be sold into Africa, and in fact is very needed. They need training all over Africa, and they only are too happy. And most of the training is either large company or government sponsored. The same in our healthcare and various others. We opened branches in Mauritius, where we've been for a while. That unfortunately was materially affected by the COVID, because Mauritius is a place for holiday, and holidays require holiday staff, hospital staff, hospitality staff. And our hospitality staff were sent on holiday because there were no people coming to visit the island. So we have made some adjustment there in terms of management, overhead, and we believe that it will be a while before the island comes back to normal. There are other of our products that we're looking at selling in there, such as the insurance product, and that is still a work in progress. We also have opened up in Mozambique, and we have big hopes for Mozambique. They've got gas fields coming there, and we've created the relationships. We've attended their conferences in Europe, and we've created a good flow of what we can do for the development of these gas fields. The gas fields are estimated to employ 10,000 people for a period of at least 5 years. So that's where our investment in that area is going. At the moment, it is very small, but we do have clientele, and we hope as soon as they open up that this will take off again. We also are in Namibia, particularly in the training sphere, and that has been doing well. We expect it to continue doing well, and it did reasonably well through the COVID. And in Botswana, we sell the insurance products, staffing, and financial services, and they had a reasonably good period there, but it all went on lockdown, so things froze, and we're just waiting for it to open up again. The outlook for us, for Africa, is very important because we think that it changes the scope of our market from a South African market to a Southern African and possibly further market. We have the IP, we have the people, and we have the inputs that are required. And so this will remain a targeted territory for us. We can't say how long it will take to take off, but we run conservatively, and we expect profitability to come in the course of next year. Some of the profitability has already been seen in this year. So, Brian, that is the summary that I have of the different clusters. And I hope that it informs your clients and the people who are listening, the attendees. I hope it informs them well. If there are any questions, and Willie van Wyk, who's my favorite financial director, and I've only got one. Willie, is there anything that you feel you would like to add to what I've said from the financial point of view?
Yeah, and I've put a slide up there just of the salient features. So if we could just literally take just a minute or two just to take, through the translation of what you've spoken to as to how that actually impacted on the bottom line.
Yes.
Yeah. So you hear yourself already.
Right. Bill, do you want to take that, or should I do it? I don't know if he's on mute. Let me take it. So what we can see from the slide that they put in front of me is that our revenue decreased by approximately 16.9% to 1.3 billion compared to 1.5 billion last year. EBITDA impairments reduced by 52.2% to 44.1 million compared to 92.3 million. So that was the effect on the EBITDA. Our cash flow was significantly good. Cash flow from operating activities increased to 307.6 million compared to last year, 48.5 million. Of course, all of these things have got context, but I think in the interest of speed, we'll just go through them. Our earnings per share decreased by 146% to minus 8.5 cents per share compared to 18.5. But the earnings per share, excluding impairments, amounted to 8.7 cents per share positive compared to the 18.5 last year. Our healthcare cluster delivered revenue growth of 4% and EBITDA growth of 31%.
Thanks.
I think that gives a complete picture, Brian.
Yeah, no, that's great. Excellent. And I would just say to our participants, they can start putting questions onto the platform.
Yes.
We have a couple of questions here. Obviously, COVID has started one of the biggest work from home experiments that we've ever seen.
Yes.
Yeah. To what extent do you see this impacting on your business and business model going forward?
Well, clearly, the work from home, everybody says it's here to stay. I think there are two aspects to it. I think that there are certain work from home situations that will remain, and in certain ways, offices themselves will be restructured to cater for people in a more comfortable manner, so that it could be as if working from home. But if people are going to be working from home, they are more than likely able to be outsourced because the whole management of that person becomes something that is out of the sphere of the company itself and becomes within the sphere of a temporary staff provider. So a temporary staff provider can cater for so many different aspects of the work from home. So we don't think that it will be a negative. We in fact feel that it could be a positive going forward.
Yeah, interesting. Yeah, I mean, we've
Can
seen.
I add?
Yeah.
Ryan, can I just relate a quick story? There is a situation which we've been looking at where a company, what they do is they work from home in South Africa for clients in England. And the big advantage, for example, not receptionists, secretaries, and various other functions that you can perform. The biggest advantage is that we charge in rands, and the companies in England are pay in euro, in pound sterling. So there is a big arbitrage that happens, and the cost base from South Africa is a lot lower than the cost base in England.
And you're actually seeing some uptake from those offshore markets.
Yes, yes.
Okay. How do you think we're going to deal with this massive unemployment? I think I saw figures that there've been something like 3 million unemployed.
Yeah.
You know, I think that's going to impact a lot more on the consumer-facing businesses, but overall, it has to have an impact on the economy going forward. And what is Workforce's thoughts around that?
Well, you know, these you've got to have a very good economy to create new jobs. Okay, and the government is talking about job creation in various different aspects. We don't know how quickly they will take off. But one of my pets is self-starting businesses, and you know, every business that starts with the one man will eventually employ approximately 8. And South Africa is full of these startups, and they've been held back because of this coronavirus, whether it's somebody selling fruit on the corner, or you have somebody starting a travel agency, or whatever it is. South Africa has to become we have to encourage entrepreneurship so much more than we do, and enable it so much more than we do, to really make a gap in the employment market.
And the impact on workforce directly?
Well, you know, I don't think there would be a direct impact, other than where we get involved in assisting people to start off these small businesses. And you know, we have a project like that on hand, which we think will have some effect in going forward. The lack of employment, of course, will affect all businesses. But we don't see that it's going to affect our in the short and medium term.
Yeah. And any particular sectors, and I know you do have some exposure to retail, that you see are still going to be, I mean, retail, we know it's going to be impacted for quite a while still. Which are the major sectors in your environment that you're still a bit concerned about rebounding?
Okay, so there are two sides to that story. Where do we see that it's going to bound, and then where's it going to rebound? In terms of bounding, we see that there's going to be a very big development in the agricultural sector. It's a very large employer of staff and of labour. It gives many jobs, and We see a lot of training initiatives going into there. We're seeing a lot of independent businesses growing. So we see agriculture. We also see that your travel business, your local travel from overseas, and that's going to regenerate itself again. It might take 6 to 9 months, but we're hopeful that that will go up. There was a big boost in our business in terms of online retail, places like Take-A-Lot and various others. We staff their warehouses and delivery segments, and that took away from the other retail. So there has to be, there may be a rebalancing of it. I think that it depends on people's appetite to go and shop at shops instead of online. Okay. So there's going to be a balance. Then the other thing is the infrastructure development that is promised. I think the aim of the government is to employ a lot of people on infrastructure. Does that help you, Brian?
Yeah, no, that's great. And we did have a specific question from the audience around the tourism sector and restaurants in particular in South Africa. I think you've largely answered that. Yeah. And then
I think it's one change in the change in restaurants is, here I'm being quite critical. A lot of the restaurants employ people without going through the formal channels. And the result was, during this period of the lockdown, a number of the waiters and etc. in restaurants, who are like our favorite people, didn't receive UIF because there hadn't been any formal. So I believe that that's going to change. Our meal costs might go up, but I think that's one of the beneficial parts that we have.
Yeah, yeah. Okay, and turning a little bit, you made quite a big acquisition at the beginning of the year in Chartle, and it looks like it was quite fortuitous for you in that they were not a traditional training business and were really geared up for online. So you spoke a little bit earlier on. Maybe you can give a little bit more flavor on that and how that impacted and helped the balance of the business as well.
Yes. So the beauty of that business was that it was completely, and has been for a number of years, completely online. It does its training online, it does its testing online, and it's but the programs that they have are directed at banks, financial institutions, and they also run degree courses, and Bachelor of Administration, etc. So they were very specific courses. So we couldn't take advantage of those courses in our other segments. But what we were able to do is use the technology that had been developed and proven, which takes years to do. And we brought that into, first of all, into Training Force, where they run a number of short courses, and then into Prisma and into our mining training. So this is still a work in progress, but I can say that we are doing quite a significant amount of our training into those areas. And of course, what it also does is it broadens your market, because once you're online, you again, not restricted to the South African market. You are now training at places where you couldn't train before because of distance or because of not having a facility there. So we've got a marketing campaign that will try and take advantage of this, but it has opened things for us. It was, from our point of view, a very lovely purchase and very fortunate.
Thanks for that, Ronny. I think we're going to move to wrapping it up. We don't have any more questions, but I've got just two in summary before I say you. In summary, it looks like you're going to probably get to about 90% of 2019's kind of revenue figure by year end. It doesn't look like you're going to be able to catch up much of that. It looks like what was gone in those first 3 months, which were really terrible, one can't really catch up.
Yes.
So we're this year being a bit of a write-off, but it seems, and for many businesses, it looks like they'll be able to next year get back to where they were in 2019. So I'd like you to kind of talk to that, and then how would you react if we were to have a double dip? So if we, unfortunately, the reinfection rate came back and we went back to stage 4 or 5, is there anything you would do differently now that would mitigate against that?
Well, I think, we're conscious of the fact that there could be a second wave. And, taking as examples what has happened overseas, I think they all seem to have second waves. But the extent of the second wave is different. The psychology that applies, the people's state of mind, is also different. And the other big thing is the rate of recovery has changed tremendously from the beginning of the first outbreak to where we are now. And that is because of the learnings of the doctors and the techniques that they use. So if there is a second wave, we won't react in the same way. But if the second wave means that our clients are being closed, then but our vision is that that's not going to happen, that it will be the approach of the government and of the recovery will be different to what it was in the first wave.
Okay, and talking to next year, in summary and conclusion.
So in summary and in conclusion, I would say, first of all, for the end of this year, I think our second 6 months would be at the 90% level, but we would definitely not make up what we lost in the first 6 months. I think in the next year, I think for the first quarter of next year, activity will still be subdued. It won't be where it was last year, but I think that after that, it should start coming back. I think some of our diversifications will start paying off in the second half, in the second year, next year. Because of new markets that we're getting into, etc. But there is still a lot of sensitivity that we have to be aware of, and we have to be cautious and look after our rands and cents.
Yeah, no, I think, and everyone's feeling equally nervous and paranoid about that cash situation, being able to carry it through. But really good news to hear that you're almost back at 90% of activity levels, and I think that's something very optimistic for the whole country. And we have heard from some of the other companies reporting results recently, and that seems to be the picture that that the recovery is sort of underway, at least for the moment.
Yes.
So, in conclusion, I'd like to just really thank you for attending today and giving us your time and the presentation. I'd like to just remind everyone that you can pick up both these interim results and the interim results booklet off the Workforce website. Have a look there, have a look at the detailed numbers and the presentation to reinforce what you've heard today. As I've said, significant value still to be unlocked in the share, given that it's trading at such a significant discount to its tangible NAV. It's probably, at its lowest, given the recent performance and people's still possible pessimistic outlooks. Yet we've heard that the company has recovered to almost 90% of levels of where it was before lockdown. So also keep a lookout for our research report, which will be out in a couple of weeks, and you can get further advice around valuation and how we feel about it. So once again, thank you very much to you, our attendees, and to our panelists today. And we look forward to hosting you once again within the next couple of months. Thank you very much.
Thank you, Brian. Thank you for having us.
Okay, pleasure. Keep well. Bye,
Thank you.
everyone.
Bye.